Hello and welcome back to our YouTube channel. My name is Neil Kane. Today I'm going to be talking to you about why federal employees may be missing out on one of the best estate planning techniques via the use of a revocable living trust. So let's get into it. What is a revocable living trust? Why is it important? Why do people utilize it? Well, for starters, it allows your beneficiaries to have access to that trust immediately, right? That trust is created, it's a living entity. It doesn't just take, unlike a will, effect when you die. It operates immediately and continues seamlessly into your death versus a will, which a will does not operate this way, right? It takes place when you pass away. Additionally, it is revocable. Anything that you want to change or adjust, amend, it can be changed. A revocable living trust is one of the most flexible estate planning techniques. It adapts to your needs. You can adjust it to avoid estate taxes, to include spending thrift provisions, which I'll talk about as we get into the rest of this presentation. The first and major big benefit that a retiree will receive, right, or a person will receive, in this case, a federal employee, is going to be avoiding probate. This is so key because versus a will has probate. And so what that means that the process of a will is to first go into probate court to then essentially file the will, attain a letter of testamentary to be the executor. Then you need to file for a tax ID on the estate, and then you need to open up an estate bank account. There's so many things that you have to do when you have a will as a beneficiary, whereas a trust skips all of that. A trust literally flows right into the next beneficiary because it is already a living, breathing entity. Additionally, there's privacy protection. So, privacy protection uh, for a will is non-existent. A will, as soon as you file the will in probate court, it will be broadcasted to all your creditors, to even your family members that would be interested in knowing what your estate is, how much it is, and therefore they can make claims against that estate. The trust is the exact opposite. It is completely um, uh, hush hush. There is no announcement of your assets. All right. And it's completely private. Incapacity planning is a third big key, I think, for a trust because, unlike a will, if you're deemed unable to manage your assets, your family has to go and seek out paperwork in a court to be appointed a guardianship over your financial affairs. Inside of a trust, you can already make that very easy for your family by putting in what's called a successor trustee. Now, the successor trustees are obviously someone that can be outside of yourself if you pass away to execute your trust. But additionally, that successor trustee can be appointed to manage your affairs even in your lifetime if you are incapable of doing that. So that is an additional feature I think is really nice, as well as creditor protection and divorcing spouse protection for your beneficiaries, which I'll get into here in just a second. But when we talk about additional features of a trust, we got to talk about what we call disclaimer trust, children's subtrust, and then spendthrift clauses. These are all additional items that we can add to this trust, and some are more important than others. We'll talk about which ones are more important and which ones you really should be paying attention to by looking at this flow chart. So I will start off with item number one. Item number one is going to be your revocable living trust, right? When you pass away, that revocable living trust will then flow into your surviving spouse's revocable trust, which will be created at that moment or already have been created by having two trusts created in terms of your estate plan. Now, if your estate plus your surviving spouse's estate is over the estate tax threshold of $12 million, then some of these assets should be passed to what's called a disclaimer trust. This can be elected once you pass away. Because if your assets in combination with your spouse's assets are over 12 million, which is the estate tax threshold, then they're going to incur any overage on that is going to incur estate taxes. If assets are then passed to the disclaimer trust, any overage, let's say there's a $15 million estate, and you want to pass 3 million to a disclaimer trust, great, because a disclaimer trust is going to avoid estate taxes. There are no estate taxes on this disclaimer trust, which is a huge deal. You also receive creditor protection here, which you don't in this revocable trust for your spouse. Now, why wouldn't everyone pass assets to a disclaimer trust? Why would you avoid that opportunity if you can avoid estate taxes? Well, there's a big reason why. Because a disclaimer trust has no step up in basis, step up in cost basis. So what does that mean? Well, basically, when you pass away, your assets get a step up in basis, meaning that home you purchased for $200,000 that's now worth $1 million, that gets a step up in basis, right? Meaning that now gets registered as $1 million as to what the cost basis is. So when your family sells it, they don't incur capital gains, right? So essentially, if any assets go into this disclaimer irrevocable trust to avoid estate taxes, right, they don't get a step up in basis. So what does that mean? You can't get your cake and eat it too. You can't avoid estate taxes by shifting assets to a disclaimer trust and avoid estate taxes and then get a step up in basis at the same time. So why would you want all of your assets as much as possible to go in a revocable trust subject to that estate tax minimum? Is because you would want, number one, the flexibility of keeping this revocable, but number two, you would want absolutely to retain the step up in basis. So the revocable trust retains the step up in basis, right? And that is key. So most federal employees are not going to use a disclaimer trust unless they've got some serious family wealth. They're going to then drift their assets to their surviving spouse's revocable trust. Now, from there, once that happens, that is assets that get kept in the estate, hence why you're getting the step up in basis. If you shift them outside of your estate, there is no step up in basis, but it avoids estate taxes. You're then going to have the decision of what do you do with the in-term beneficiaries, which are your children. So from here, you have the decision, do you pass these assets directly to your children or do you pass these assets to what's called an asset protection trust? Well, that decision is really more about, do you want additional safety measures there for your children? So one additional safety measure for your children that is a benefit of giving them their inheritance through an asset protection trust is it has creditor protection, okay? Which means that if there's any creditors that are out there against your children, they've made some bad loans, they can't get to the asset protection trust that you've left your inheritance in for them. Number two, let's say they get divorced. If they get divorced, too bad for that spouse. The spouse cannot penetrate this asset protection trust as well. So number one, we're getting creditor protection and we're getting divorce protection for that child. Number two, let's say that child is a big spender. Well, we can add in a spendthrift clause, right, to that asset protection trust as well. That's a big component if you're fearful that your child is going to blow their whole inheritance. Now, the question is, do you make those elections now? No. You put those as options to those asset protection trusts, right? Especially the spendthrift clause, to be deemed a decision later on. That's the whole point of this amendable, flexible trust. You may think right now that you're going to add a spendthrift trust to one of these asset protection trusts for your children because your certain child is a spender, the other two are not. Maybe, but then towards the end of your life, or let's say your spouse's life, because she can make that adjustment too, that's not needed. Okay, therefore, spendthrift trust isn't added to anything. It's it's avoided. Okay, but that can be added in at a later date. You just put that election in as a possibility to your asset protection trust, and great, you've got that in place for those for your children if needed. In addition to this, right, we've got the spendthrift trust that will avoid creditor and divorce spouse protection for all asset protection trusts. That is the beauty of those. Now, when it comes to additional things that can be confusing, one topic is what's called a generational skipping trust or a non generational skipping trust. So let's take that asset protection trust that you're leaving as that end kind of inheritance for your child, and let's assume that that child is going to be a big earner. Maybe they're executive of a technology company and they are going to have inheritance tax for their children, meaning there's going to be inheritance tax because there's over $12 million. Now, keep in mind that inheritance tax threshold used to be $1 million back in the 90s. It's 12 million now. But let's say it's going to be a problem for them. For that asset protection trust, you could leave that as a generational skipping trust, and therefore anything that asset protection trust will avoid estate taxes for generations upon generations. But what it won't do is it won't get a step up in basis. So if your children with their inheritance are not going to be anywhere near that estate tax threshold of $12 million now, it's going to be a non-generational trust, a non-GST trust, which is going to be probably 95% plus of all our client base, which are fellow employees watching this. Okay. Now you can customize this. You can, tailor for each child, which it's going to be. You don't have to make this decision now. This can be in a decision that gets, allows for flexibility and changes because, again, this is all within the confines of a revocable living trust. It is amendable. So let's touch on retirement accounts because a lot of people, they get a trust. They think, okay, well, does the trust own my retirement plan? No. Retirement plans will always be separate from the trust, but you can put a beneficiary as your trust, right? So you can update your beneficiaries, but you got to be careful because if you add in provisions like a spendthrift trust that says, hey, my beneficiaries can only spend 5% of the trust corpus every single year or only access to the income, well, guess what? If that's the case and that's stipulated on anything that comes through a retirement vehicle, that's going to be in conflict with some of the IRS's rules, like a 10-year withdrawal schedule that must be done after inheritance. So you want to make sure that there's exact verbiage in that trust that stipulate anything that is inherited through being the beneficiary of a retirement plan, that there is a different clause that gets spent in a different fashion that is in accordance with those IRS rules. So that will allow you to avoid any problems in that scenario. So when we talk about trust, the last and most important piece is implementation. A lot of people go through the process of creating trust documents, but guess what? They never actually fully execute that trust. Number one, those documents should be signed and notarized. Number two, and the most important part, is going to be the funding of the trust. So what, you've got a trust completed. If your assets aren't retitled to that trust, like your investment accounts and your real estate assets redeeded, that trust is doing nothing. You've got to make sure that is in place. And if ultimately you add in those provisions in your trust about your retirement plans, you can update those beneficiaries to it. But that is the most important part of the estate planning process, is the aftermath of that. So the last component that I'll kind of talk about in terms of estate planning is the fact that most people do not take action. In fact, 55% of Americans don't have an estate plan. 31% have a will. Only a small amount of the population, 11%, have a trust. This is accordance to a survey that Trust and Will, which is a company that we use for some of the estate planning for our clients, took. It is a staggering number how many people don't have an estate plan. Don't be that person. We're making a major initiative for our clients to get estate plans, whether that's a trust or a will, right? But don't be the 55% with no estate plan. And again, really look at the idea of a trust. It avoids that probate process. It can save those costs. And more importantly, it can save time. Trust and Will did a study that on average, it took 20 months for a probate process to be completed. And that goes from finish to end. All of the components I talked about, generating a tax ID, right? Generating an estate account to distribute assets in beforehand, going to court, filing the will, becoming the executor, getting the letters of testamentary, filing a estate tax return as the final process in that. It's lengthy. Trusts avoid that whole process typically. So we really recommend for folks to take a hard look at those and decide whether that's going to be a good fit for the estate plan. If you've got questions that arise from this, we've got a great team. We've got 4 CFPs that are all astute in estate planning. We follow that up with an amazing support staff right behind us. Please utilize our team. If you're a current client, engage with us, set up a meeting to discuss this. Or if you are not a client of the firm, feel free to register on our website by going to retfed.com/register, or take a QR code, scan that with your phone, and you can schedule a meeting with our staff. We give 1 complimentary consultation as a part of our meeting packages in talking with us. Lastly, in fact, the largest and biggest one, please subscribe to our YouTube channel. Like this video. All right, there'll be an option right here in the bottom. Hover your mouse over it. Like the video, subscribe to our channel. That really helps our initiatives, and that is exactly how you can promote us into the YouTube algorithm and space, which is exactly what we're looking for. So take care. I hope this video was informative, and we're looking forward to seeing you guys on upcoming sessions.